Hello and welcome to your market outlook on the impact of Greece. This is Patrick Seresna. We are now witnessing the culmination of the Greek drama. The perennial tensions between Greek national sovereignty and European economic unity are coming to an important crossroads, and uncertainty has increased the anxiety of international investors. With the U.S. markets closed on Friday for the 4th of July holiday, it will only serve to heighten anxiety, as there may be an increasing reluctance to hold exposure over the long weekend into the Sunday referendum. Our initial opinion is that we're witnessing a very calculated negotiation between Europe and Greece, where both sides are carefully applying game theory to try to end with the most optimal outcome. Just like a union strike against management with the threat of a strike or a lockout, these deadlines are far more a negotiation ploy to strengthen one's position than they are an absolute. The only consideration that is truly a risk is that game theory's mathematical models can only study conflict between intelligent, rational decision makers. With such extreme psychological and economic pressure being experienced by the Greek people, it may lead to a very irrational or unexpected outlier outcome. This is where technical charting on the markets will fall short. The next major market trends will likely start from an outcome that cannot be anticipated with certainty. Let's take a look at the S&P 500 and Euro technical levels. So first off, here I have a chart of the Euro versus the US dollar on that September futures contract. This is a daily chart, so we're looking at about a year's worth of data. And this is where the major downtrend of the Euro against the US dollar occurred up until the March short-term bottoms. We have really seen a very shallow sideways range develop over the last 3 months, and surprisingly, in spite of all of this Greek drama, the Euro has yet to start any significant trend move. While it may be speculation, we suspect that the central banks of the world are in fact intervening to try to create euro stability during this crisis, because it would weaken the negotiation stance of the European Union if we were in the midst of a sharp euro decline. The euro has now been in a very tight range, and in fact the next major trend move is likely to emerge at the resolution of the next week or two, and with either a break higher or lower out of this consolidation point. We continue to favor that the euro will eventually break down, but likely not starting immediately. When the technical levels of the 110 area are broken, that will really start to mark the potential beginning of a much larger decline in the euro, maybe not only back down to the lows, but eventually heading toward the parity level. We are not going to actively be short the euro until that technical level is actually violated. On any short-term break above 114, for instance, if there was a resolution which created some short-term buying, it may result in a very short-term rally up toward the 116, 118, and define a further sideways consolidation for much of the remainder of the summer if we had that upwards break. Nonetheless, our bias remains that the euro is likely to start to deteriorate below the 110 level at some juncture here. Next year I put up an S&P 500 September futures contract 4-hour chart. So each candle is representing about 4 hours of trading in a 24-hour market. And so we're getting a little bit of a zoomed in chart from what most people are used to looking at in terms of the daily charts. What we have here is a very key support line now being tested on numerous occasions around the 2050 level on the S&P. That has at least initially held the supports. We suspect that that could be a short-term swing low. We certainly have already seen throughout this morning short-term rallies that are now going to test some very key technical levels. We want to make sure that our members can observe a couple key turn points in this. You cannot be structurally bullish the S&P until we see any real legitimate rallies above this 2080 to 2090 level. Any rallies this morning throughout this afternoon that continuously are failing at those levels really are vulnerable to yet again another round of selling, especially into Thursday, where there could be some distribution going into the long weekend. If we do see that these technical levels are failing, the immediate downside targets have the markets potentially weaken right back down to these previous lows, and or potentially down towards the 2020 to 2030 levels down, where there are some significant supports as well. These are levels that if the market tested would not actually be yet structurally bearish. We really cannot say that a really big and meaningful market correction is underway until these types of lower technical levels are violated and opening the floodgate for a far more active distribution. Even if we did see a very fast 20, 30, 40 point drop in the markets going into Thursday, it could still lead to a short-term bottom that after the weekend resolution next week could form a short-term low and then subsequently begin a rally right back toward the highs. We're not fully convinced that this is really a very aggressive new distribution cycle, especially with the fact that there could be a resolution as early as this weekend, at least in terms of removing that tension from the markets, that we could see bounces off those levels. So, could we see a scenario where the markets sell off Thursday, create some sort of a low, and then the markets then retrace back up to highs? Absolutely. So we're right now not fully bearish the market. We still think that there's going to be a lot of chop in this area. It's far more likely that the earnings that are going to start coming out into the middle of July may in fact have a bigger impact on the ultimate break of this market than the outcome of Greece. Let's see how it all plays out over the weekend. That was your Option Source Market Outlook. Thank you for joining me.